Over the past few months, I've received lots of questions from people about how much gold or silver a person should hold. It's a very good question, though it will depend upon a person's temperament and personal situation. I've often stated that I'm not opposed to a person holding up to 100% of their wealth in gold, though I've also qualified that statement with a disclaimer that a person should only do so if he or she is very knowledgeable about the metals market and is convinced that the metals are historically cheap. I've also said that even if a person thinks the metals are on the expensive side, he or she could scale back the percentage of metals held, but should hold at least some minimum quantity of the metals in their portfolio to hedge against turmoil in the financial world. That minimum level is approximately 20%. I've given some reasons for this 20% minimum level in the past, and used as a means of justification the fact that gold would need to revalue upward by a factor of at least 5 if confidence in the dollar is lost. Today I'd like to discuss another reason for this 20% minimum level, and that is how it can be used to provide a more predictable return from the portfolio of assets that you choose to hold. So let's get started. On this slide, I've tabulated the real inflation-adjusted returns from various assets going back to the year 1970. The main assets I've included were gold, silver, stocks, as represented by the S&P 500, and bonds, as represented by the U.S. 10-year Treasury note. The way to interpret this chart is to select a year and then pick off the rate of return that was realized for the 10 years that follow. For example, in 1985, the curve for bonds reads 7%. What that means is that starting in 1985, if a person bought a 10-year Treasury bond and held to maturity, that person would realize a 7% per year real inflation-adjusted increase in his or her wealth. This is before taxes, though, and so one should keep that in mind. Gold, on the other hand, had a minus 2% per year real rate of return from 1985 to 1995. The chart ends in 2005 because that is the last year for which we know the 10-year real rate of return going forward. You can see from this chart that some assets offer much greater predictability than others. The bonds tend to be the least volatile over a 10-year holding period, but we can see that even the bonds sometimes offer a real loss in purchasing power. If you look at the starting period from 1970 up until 1975, you'll see what I mean. Even marginally positive real returns can result in a real loss in purchasing power after taxes, though that isn't taken into account here. Another risk that isn't shown here, mainly because this 35-year period of time didn't include it, is the possible reset event where confidence in the currency is lost or the government purposefully defaults on their obligations through a change in the money. This is a real risk that should be considered, and another reason why I say that you need to have some gold, but we won't discuss that in this video. Speaking of gold, we can see that gold is quite volatile in terms of real returns. Silver is even more volatile. Both of them tend to move in the same direction, but silver offers more of a wild ride. This is one of the reasons I suggest that unless a person is absolutely sure gold and silver offer a compelling value, it's usually good to hold some financial assets. We can see that when gold and silver do poorly, bonds tend to do well. And so bonds are a natural way to hedge against poor metals performance, and vice versa. Holding some bonds is a good way to ensure that if cash is needed at some point in time, it is not necessary to sell gold or silver at an inconvenient time. But there are definite limits to how much a person should hold in bonds, and I will discuss that in a moment. First, let's simplify this chart and summarize the returns and volatility seen from these assets over this 35-year sample of starting times. Here I show a set of 4 dots plotted on an XY chart. On the x-axis is the standard deviation of 10-year real returns observed. On the y-axis is the average yearly real inflation-adjusted return realized from each asset. The standard deviation is just a measure of unpredictability. For those who are unfamiliar with the concept, it is sufficient to know that about 90% of the time a value will fall within 1.6 standard deviations of the average. For example, take stocks. According to this plot, stocks had an average real rate of return of 3.1% and a standard deviation of 5.8%. If we take 5.8% and multiply by 1.6 and subtract that from 3.1, we get minus 6.2%. If we take 5.8% and multiply by 1.6 and add this to 3.1, we get 12.4%. So 90% of the time, the 10-year average rate of return on stocks was between 12.4% and a 6.2% loss. You can go back to the previous chart and verify that this is pretty close to what was observed. Now it's interesting to take a look at the long-term returns for all of these assets relative to each other. They were all positive. What I find most interesting is that stocks did not perform as well as either bonds or gold. This is not an opinion, this is fact. According to the conventional wisdom, and by the way, I'm not an adherent of the conventional wisdom, stocks should have outperformed bonds and bonds should have outperformed gold. But over this quite long and meaningful period of time, that's not how it played out. My theory for this, and it's only a theory, is that everyone now believes that stocks will outperform bonds, and so this belief is already baked into the price that people are willing to pay for stocks. In other words, the risk premium on stocks has all but vanished. Stocks just do not offer the compelling value that they once did when people had to buy individual stocks and be exposed to the risk that their investment would go bust. With today's index funds, people can simply diversify that risk away. In addition, they are also willing to pay more simply because they see stocks as a guaranteed way to outpace inflation. But as one can see from the previous chart, there were long stretches of time when stocks failed to outpace inflation. Gold is another matter. The experts say that gold provides no return. I believe that since gold is still money that is not inflated, it tends to appreciate over time. In other words, the benefits of productivity improvements tend to flow towards the holders of gold. I discussed this at length in my video series, Gold Money Appreciates, for anyone who wants to check it out. But it is interesting to note that gold has appreciated in real value by about as much as long-term bonds have returned. And because there were no distributions, no taxes need be paid until the gold is liquidated. Now, taking this chart by itself, one might be tempted to conclude that it is prudent to hold only bonds. You and I both know that it is certainly not the case. Bonds are not 100% risk-free. In fact, they can be quite risky if one takes into account the potential for a debt default or a loss in confidence in the currency. But at the same time, even if a person is concerned about the safety of bonds, it is probably not smart to go 100% into stocks or gold or silver. After all, sometimes we need to come up with cash to cover sudden large expenses. Gold, silver, and stocks tend to bounce around a lot in terms of valuation. If we hold 100% of any of these assets, we are likely to find ourselves in times when we need to come up with the cash and have to clench our fists and bear it while we sell our assets at unfortunate times in order to come up with that needed cash. But there are alternatives. We can spread out the risk a little. Let's see what would happen if we spread out risk between stocks and bonds as most financial quote-unquote experts would propose that we do. Here's the result. The way to interpret this chart is that each circle is a 10% increment in stocks. In other words, if we start at the 100% bonds dot and move over one circle, this would be what we'd get if we held 10% stock, 90% bonds. Each one circle move to the right is a 10% more stock, 10% fewer bonds move. The experts generally tell us to hold as high a percentage of our portfolio in stocks as our risk capacity can tolerate, and then hold some bonds for stability. But what does this curve tell us? Quite frankly, it tells us that every 10% increase in stocks not only reduced the predictability of returns, but it also reduced the average return. How is this a good thing? Quite frankly, it's not. Maybe if the theory that stocks are guaranteed to outperform bonds was correct, it would make sense to hold more stocks. But over this extensive period of time in history, stocks did not perform better than bonds. And this was a pretty long 35-year period of time. And it was quite frankly the widely held belief that stocks will always outperform that killed the goose that lays the golden eggs. Speaking of gold, let's see what happens when we mix gold with bonds. Here we see some surprising behavior. As we add gold to a portfolio of bonds, the curve actually starts by moving to the left. The addition of up to about 25% gold to a bond portfolio actually makes returns more predictable, not less. Again, this is contrary to what most financial quote-unquote experts will tell you. They will say that gold is a stupid investment to hold because it is volatile and does not pay interest. To this, I respond that gold is not an investment. Gold is money. An investment requires a return on capital as well as a return of capital. With gold, you already have your capital in your hand. No financial asset shares this quality. I also argue that gold does have a return. It is just one that does not require a distribution to be made. It's a hard concept to wrap your head around, but good money does appreciate. It was true for the dollar in the days of the hard dollar, just as it is true for gold today. But back to the curve. Once we get beyond about 25% gold, we see that the volatility starts to increase. Notice I did not say risk, I said volatility. Volatility is not the same thing as risk. The volatility is simply a measure of how much the valuation will bounce around. If you are forced to liquidate to meet cash expenses, then volatility could be a risk. But if you are not forced to liquidate, then volatility is not quite as dangerous. A debt default or loss of confidence in the currency is also a risk, but one that increases the closer you get to the bond end of the curve. But again, that is not accounted for in this chart, but it is a risk that you need to keep in the back of your head at all times. Just as we determine the volatility and average return for various mixes of gold and bonds, we can do the same for gold and stocks. Notice that just as was the case for bonds, the addition of gold to a stock portfolio makes the returns much more predictable. As we add gold in 10% increments to a stock portfolio, the volatility moves sharply to the left until we get to a point at which we have 40% gold and 60% stocks. This is the least volatile point on the curve. Beyond this point, the volatility of the portfolio starts to increase with the addition of gold. It's interesting, isn't it, that a mix of 40% gold and 60% stocks is actually less volatile and more predictable in terms of real return than a portfolio of 100% bonds. I doubt that anyone in the mainstream financial press is going to tell you this. To be complete, though, we should also ask ourselves what happens when we add silver to a mix of bonds and a mix of stocks. Here I have done so. I'm showing various mixes of silver with stocks and bonds. Just as was the case with gold, a little bit of silver makes a bond or a stock portfolio more predictable. Though we can't add as much silver as we could with gold before the volatility starts picking up. We can see that once we get beyond about 20% silver with bonds, the volatility starts to pick up, and once we get beyond about 40% silver with stocks, the volatility starts to increase. Unfortunately, we also see that even though we reduced the volatility of the financial asset portfolios with the addition of silver, we also reduced its average return. This is because silver did not perform as well as gold over the past few decades. This is not to say that silver won't perform better in the future. It might. It just didn't do so in the past. When all is said and done, though, it appears that for the past 4 or so decades, the highest and most predictable returns came from a mix of bonds and gold. We might call the 25% gold and 75% bond portfolio the Sweep Easy portfolio. It offers the protection of gold with the predictability of the cash flow offered by bonds. For someone who knows absolutely nothing about gold or how to value it, this is probably the best asset allocation to adopt. It offers a very predictable yearly rate of return. Any less than 20% gold, and not only does one face less predictability of return, but one also loses the insurance gold offers against a currency event. Now, many staunch gold and silver bugs will argue that this is simply not enough gold and silver. And for some, that's probably very true. But that assumes that one not only understands gold and silver very, very well, but is also of the temperament and personal situation to withstand variations in the subjective value given to gold and silver over time. Many simply are not in a position to accept the volatility of a 100% metals portfolio, and that's okay. As I've shown before in my videos, even as little as 20% gold is enough to cover a person in the event of a currency reset. Okay, so that said, let's tie all of this together. Here's the original chart of returns showing the 10-year real returns of various assets. I added the 25% gold, 75% bond portfolio to it, as a black curve. Notice that the real return bounced back and forth between 0% and 7% per year. It never showed a real loss in purchasing power over a 10-year holding period, and was much more predictable than any of the other asset classes by themselves. This is quite a nice option for someone who is simply a saver and does not understand gold well enough to stomach the variability that comes with holding a gold-heavy portfolio. I hope what I have shown you here proves to be helpful. My main intent was to show another reason why a person should not hold less than 20% of their wealth in gold. It was not intended to suggest that a person should hold 80% of their wealth in bonds, but it does demonstrate that having a significant amount of bonds, maybe even as high as 80%, is an option for a person who doesn't understand gold well enough to commit to a larger gold holding. Someone who knows gold well and knows how to value it should consider a much heavier allocation to gold